The subject of today's webinar is what do large universal banks do? And we will try and mix a bit of an exploration of how banks work with Finance Watch's position on some of the bank policy debates that are going on now. So universal banks, let's start with what they are. Universal banks combine commercial banking and investment banking activities. Commercial banking being high street banking or retail banking, and it's what we traditionally think of as banks. It's making loans, taking in deposits, and allowing payment services around the economy. But universal banks also have trading activities, trading assets in financial markets, securities, and derivatives. And Finance Watch's position is that these things should be separated. And the basic reason that we think these things should be separated is that commercial banking cannot be interrupted even for a day. If you imagine that your bank account suddenly disappeared and then your monthly paycheck wasn't available, you couldn't pay your mortgage, you couldn't receive your pay packet, that's what stands to happen in the economy should commercial banks fail or a commercial bank suddenly disappear. On the other hand, should an investment bank fail, the consequences for the economy are much less immediate, and therefore while governments and society in general must stand behind commercial banks, they needn't stand behind investment banking if they're not too big to fail. And this explains why Finance Watch really thinks that there should be a separation between those things which absolutely must be rescued, which basically fall within the commercial bank, and those things which could fail if the business got in trouble without causing systemic damage, which is in the investment bank. So that's a sort of a highlight of what we're going to do today. We start with an explanation of commercial banks, move on to securities trading, and then on to how the largest universal banks have changed within the last 25 years. So part one, as I say, is commercial banks, and really that tells us why we need to bail out banks. By understanding what commercial banks do, we understand why we need to bail out banks. So we start here with a model of the economy which doesn't have any banks in it. John has made some stuff and he wants to sell it, but Ringo hasn't got any money. So what they do is, a very common practice is John sells it to Ringo on the promise that Ringo will pay him later. It's totally common practice. I give you the stuff and an invoice to be paid later. So this means that credit here, trade credit, has allowed the exchange to happen. So it's a way that credit allows things to happen in the economy. But the problem John has is he can't do anything now until Ringo settles his debt. And this process can go on, and credit really can make things happen in quite long chains of credit. But until some money is found and the debts are settled, John can't go off and actually make anything else, for example. In this second example, we introduce a bank. I'll just go back there and say chapter 2 is we introduce the bank and we see how the bank's promise to pay does something different, especially because it becomes to act as money. In this example, instead of Ringo extending an IOU to John in payment, he actually borrows first from the bank. Now when you borrow from the bank, they don't give you a big pile of notes and coins, they give you some money in your bank account, and that really is an IOU that you can go to the bank and draw down money when you need to. But the fact that you have this IOU from the bank allows you to go and buy stuff with the bank's note. Would have originally been a private bank note from the bank. So again, the credit allows the exchange to happen without any notes and coins, basic money being involved. The big difference now, though, is that John can use that bank IOU to go off and buy more stuff or make more stuff. So he can buy inputs into his production process, he can hire people to make things, and so you can see that because a bank's IOU comes to act as money, more simultaneous economic activity is allowed. And the same thing happens with George and Ringo. George borrows some money, and that enables him to buy from Ringo, and for Ringo then to buy from John, and the process continues such that the economy becomes completely dependent upon bank credit money. And in fact, bank credit money typically makes up about 97% of money in the economy. Central bank notes and coins really only make 3 to 5%. And if you think again, when you have money in your bank account, that's really an IOU from the bank that they'll pay you if you go and ask for it. But otherwise it remains as credit. And although you might think in your daily life you use notes and coins for more than 3% of your transactions, bigger transactions typically use bank credit money. So if you bought a house, you wouldn't buy it with notes and coins, you'd buy it by a transfer between banks. And similarly, businesses overwhelmingly use transfers between themselves to buy from each other. And so we see that the economy is completely dependent upon bank credit money. And there you see the core of why, if a bank fails, it causes very grave problems for the economy. Not only do people's wealth disappear as the money they have in their deposit accounts goes away, but in addition they can't make payments to and from each other, and so the problem spreads quickly around the economy. Recently in Holland, a bank, SNS Real, went bust, and although the insurance scheme could cover the deposits, the government was forced to nationalise them because they were afraid what would happen if payments were not made the next day, if you couldn't get money out of the ATM the next day, if you couldn't pay your mortgage the next day, if salaries weren't paid the next day. And so this imperative that you continuously maintain bank credit money really makes it essential that the society and governments stand behind failing commercial banks. So the question then becomes, how do banks pull off this trick that their IOUs come to act as money? And they do this by building their reputation. We can see here a simplified bank balance sheet. On the left is assets, the things where they have money coming to them, and on the right is liabilities, where they need to pay money out. So as I say, the first thing they need to do is build a reputation. When I worked for UBS, I worked in Zurich for a while, and there the whispers were all of gold underneath the pavements. I never saw any of it, but what mattered is that you believe that there's gold in a bank vault, and that boosts the reputation of the bank that they'll be able to pay. Secondly, when you go in, they better have notes and coins to hand, so that when you do ask for some money from the bancomat, from the wall, a hole in the wall, the notes and coins are available. Secondly, they better make good loans, a diverse portfolio of loans, and as I said, you better believe that they've made good loans, so they need a good reputation for making those loans, because it's by those loans being repaid that they'll have money to hand when you want to pull down money from your bank account. They also need branches. You need you want to feel that it's real. You need to go in and feel that you can get hold of your money, and they need payment systems. When you go on the internet to settle your bills, you want to be sure that when you transfer money between different bank accounts that it'll arrive where they say it will. As we said, one very important trick is that deposits, the IOU they have at the bank, is payable on demand, so you can get it whenever you like, and you want to know that the owners of the bank have put some of their own money in. So if some of those loans do go bad, it's them that will take the first hit before they fail to repay you. And the final element here is that the state stands behind the bank. And I'm sorry for the crown. I'm really not a monarchist, but I don't know how else to draw the state, so that's how I've drawn it. Because of the importance of these functions to the economy, society, represented here by the state, is obliged to stand behind banks and to bail them out when they get in difficulties. And we see that this government support really is a positive cycle. I mean, it is so critical, therefore governments must save it, but in turn government support of banks add credibility to their IOUs. So it's sort of a mutually reinforcing thing here, and that stretches not only to bailouts but also to things like accepting bank credit money in payment of taxes and various other ways that they support banking and bank credit money. And just a quick note here about leverage, because the thing is that once banks have established a good reputation, they're in competition with other banks to make more profits. And therefore the temptation they have is to do more loans, to do riskier loans, and to take on all sorts of other activities. And this is really the story, let's say, of the 2000s, where behind the reputation of a solid, sensible bank, banks were taking on securities activities and CDO squared and all the other things that you read about during the crisis. And it's really the role of bank regulation, or part of the role of bank regulation, is to keep an eye on this temptation and to control this temptation that banks have to move into riskier activities in order to make more profit, to keep up with the competition, while maintaining this facade, this reputation they have for safety. So we move to part 2, which looks at securities markets. And as we said before, a universal bank combines not only the commercial banking we've discussed, but also a trading book, investment banking. And the thing is with bailouts is that when we bail out the commercial banks, in a universal bank we're obliged pretty much to bail out the investment banking side as well. Finance Watch believes that we should separate them because, as you'll see in this section, we don't think that investment banking, if it wasn't too big to fail, would necessarily need bailing out with the same urgency that a commercial banking does, and therefore we reduce the bill to the taxpayer in the case of bailouts if we only have to bail out a little bit. So the thing is that some things are very large, some things will need a lot of finance, and some of them are too big to go on a single commercial bank's balance sheet, or even on a syndicate of 2 or 3 commercial banks' balance sheets. Apart from anything else, if they had the majority of their balance sheet lending to one very big project, people might be worried that if that project goes bad, they wouldn't be able to get their money back. So what developed is the securities market. And what we have here is the bridge. The bank extends a large loan here to the bridge company, and then splits it. This presentation's going faster than I am. Splits that loan up into lots of little bits, and sells it to individual investors. The money of the investors goes directly to the bridge company, and they have a claim on the profits of this bridge company. But securities markets are not the same as a silent partnership. And hold on, slow down. The thing about securities markets is the bank stands ready to buy and sell on demand. Now, obviously, that means that it sells at moving prices, which makes the game a bit more interesting. But the bank here offers liquidity to the investors, Mel, Jerry, Emma, and Victoria. And it's interesting to note that in order to do so, it has many of the same attributes that it did as a commercial bank. It must have a reputation that it's going to buy and sell at a fair price, a reputation that it'll have cash in hand to buy your security when you need to get your money back, and it must have payment systems in order to process that. You know, individuals don't have security custody systems, banks do, and they provide that to the market. Now, we're not making a note here that it's banks that really make this market, and that leads on from that last infrastructure point, really. I mean, economics textbooks will tell you that markets tend to just spring up wherever there's a problem to be solved. This is more or less pure fantasy. What happens in a market is that people make them. The people that are interested in buying and selling in markets make them. They bring the market stalls, they make the marketplace, and then they bring the stuff that they're going to sell in the market. So when you're looking at markets, you need to look at really who's making this market. And banks make markets in a double sense. First, in the sort of terminology of financial economics, they make markets, means they stand ready to buy and sell. But secondly, they make them in as much as I say, they provide the infrastructure of the market. And they don't provide it on their own. They actually provide it in combination, partly in competition, through competing with each other, they spur each other on, and partly in what you might call collusion, if you like, in that they form associations of securities markets lawyers, or ISDA is the equivalent for derivatives, or they all sit on the boards of clearinghouses and so on and so forth. And the thing is that if one of these market makers fails, to compare it with the failure of a commercial bank, the consequences for society are really not as bad. First of all, if the person that you want to sell your security to goes bust, you can simply go somewhere else and sell it to one of the other banks. The way that the industry is structured at the moment, there are 15 to 20 banks which undertake the vast majority of financial market making. They're the sort of names that you hear on the news: Deutsche Bank and Barclays and BNP Paribas and so on. So if these banks were not too large to fail, and you need to sell your security, then just because your favourite bank went bust, you would just go to another one. Secondly, you don't have any claim on the bank, so you don't lose any wealth directly. You have a claim on the bridge company. And thirdly, none of this is acting directly as money, so there's no sort of mass withdrawal of money from the system, which is so catastrophic. And the point, therefore, is that if one of these things goes bust, they should be allowed to fail like any other business. There's no reason that these guys should have a government guarantee any more than a maker of tables and chairs should have a government guarantee. And as I say, because they're combined with commercial banks and universal banks, when we bail out commercial banks, and we have to bail out these as well, taxpayers face an unnecessary cost. What we've presented so far, to my mind, makes the case for the separation of market makers from commercial banks. And at the same time is very similar to the story that banks might tell us, that they only do useful activities, that if it wasn't for securities markets we wouldn't have bridges and canals and railways and whatnot. But we also need to update that story for the last 25 years, where a process has happened where much more finance, by finance, for finance, sometimes called financialization, has occurred. And what we'll see in this third section is this has mostly happened at the largest universal banks. And it reinforces, I think, the case for separation. And moreover, it points to the need for us to tackle too big to fail banks. So this graph shows us the growth of debt securities outstanding in the Eurozone from 1989. Debt securities being exactly what we just talked about, the division of a debt into little bits that is then bought and sold by people using their bank as a market maker. And you can see the bit at the bottom, the dark blue bit at the bottom, is debt securities issued by non-financial corporations. That is, corporations that actually make stuff, not just in and I hesitate to use the term, the real economy. Just an aside on terminology, calling that the real economy sort of assumes that all of this other stuff is not real, and if it wasn't real it wouldn't be a problem. And also we can see how financialized we have become when the making of tables and chairs and restaurants, the offering of services like restaurants, is now labelled non-financial, as if it's the exception. So, small bugbear on terminology aside, we can see that it's less than 10%. I seem to remember it's about 7% of securities outstanding are for non-financial corporations. So, whilst it's true that securities markets can be useful for raising large-scale finance, something else is really going on in these markets. Now, about half of that is governments, and you can see the kick up in debt after they had to bail out the banks, the direct cost of bailouts and the cost of recession after 2008. But the top half is debt issued by financial firms, the orange part. And so you can see that overwhelmingly securities markets are financial firms borrowing from financial firms. this is reinforced when we look at derivatives, and you don't really need to know what derivatives are other than to know that they're a way of dealing in financial markets. And the pattern is extremely similar. The small blue part, less than 10%, something again about 6 or 7% at the bottom is banks as dealers facing non-financial firms. The red bit is a statistical adjustment, so we don't need to worry about it. And the vast bulk of activity in OTC derivative markets is financial firms facing other financial firms. So we see that again this pattern of finance, by finance, for finance, typical of the financialization of the last 20 to 25 years. If we now look at our bank balance sheet again, we see that what might have been banks offering loans mainly as a commercial bank with some securities issuance on the side, that basically offering the 7% that we see for non-financial firms. If you add in the finance for finance growth that's occurred over the last 25 years, we can see that, there we are, we can see that particularly for the largest universal banks, trading assets have come to take up about half of their balance sheet, and in fact represent more of their balance sheet than traditional loans do. This graph kind of tries to put that across again, but in the early 90s we see that even in the largest universal banks, trading was a small part of their balance sheet compared to traditional lending. Their balance sheets have grown enormously over the last 20 years as these banks have got much bigger, and that growth has overwhelmingly come from an increase in trading assets. And as I said before, most of those trading assets are not directly linked to the real economy, and their direct usefulness to the rest of the economy is ambiguous at best. So if we move on, how has this happened? Well, we come back to our marketplace for financial products. On the one hand, more and more of individuals' money has been pulled into these markets through things like pension funds and insurance funds. When you save in a private pension, that money is invested by the fund into stocks and shares and other financial instruments. When you purchase private health insurance, the insurance fund puts the premiums that you paid them into financial instruments. When you buy life insurance, that all goes in there. And so we've seen over the last 25 years a rise in individuals' savings and basically many aspects of their lives becoming targeted towards financial markets. That's led to a growth, and on the other hand, individuals are also borrowing more. So there's more private mortgage provision, there's more credit card debt, there's more student loans, and the combination here of investment banking and commercial banking, and without a clear separation, has also led to much of this borrowing not staying on the balance sheet of commercial banks, as we saw in the first part, where the bank makes a loan and keeps it on its balance sheet, and you trust that it's good at making loans, and therefore you're willing to deposit money. Now we have the process of securitization, where many of these individual, say mortgages, to give the best example, are grouped together and sold into the financial markets as a security of a bundle of mortgages. And this has resulted in the growth of these markets from what we see here, this sort of this massive growth that we saw above in financial instruments, because all of these securitizations of our borrowing are financial instruments, and it leads to a squeeze on the real economy borrowing and on individuals. Now, to come back to our growth of securities markets here, as I say, there's a split between the way that the largest 15 to 20 universal banks appear and the way that small and medium-sized universal banks appear. Small and medium-sized universal banks, even today, have typically have less than 5% of their balance sheet in trading assets, whereas the largest universal banks, which also benefit from a government guarantee because they're universal banks, have an enormous growth in trading assets and typically have more trading assets than loans. Trading assets tend to make up around 50% of their balance sheet. So you'll be glad to hear that we're nearly done. We had three sort of sections today. The first one talked about commercial banking, and we saw that it has a utility-like character, and that bank failure can lead to an interruption of the services, and that interruption can have systemic problems, and therefore in many ways governments or society is obliged to stand behind them, to support them. In the second section we looked at unambiguously, let's say, useful securities market activity, and we could see that although it can be useful for achieving large infrastructure, let's say infrastructure projects or large projects in the economy, the failure of a single bank in this market does not cause interruptions to the service, and bank failure need not provide problems for the whole economic or financial system. And there's a big proviso there. It's providing that they're not too big to fail. So our argument is that because of this imperative to rescue commercial banks and not to rescue investment banks, no, let's make sure I've got that right. Because of the imperative to rescue commercial banks and not investment banks, there should be a separation between them. And I note that small and medium-sized universal banks tend to look at still like this, that they're mainly commercial banks with some small amount of trading activity on the side. When we come to the largest universal banks, however, they tend to be the market makers in the largest and most complex markets. We must bail them out not only because they're commercial banks, but also because they're so big, and even the failure of their investment bank would lead to problems in the economy. They benefit from an implicit subsidy from the fact not only that they have a commercial bank, but they're so big that we would have to rescue them. And in fact, this implicit subsidy, just to touch on it quickly at the end, is directly related to the growth of financial products. Because they're guaranteed, people are willing to lend them money cheaper than they might be if they weren't guaranteed by the government, and that makes all sorts of financial instruments much cheaper to construct than they would otherwise, or much more profitable than they would otherwise be. And it's our very firm belief that if you took away this implicit subsidy, a large amount of financial instruments actually would turn out not to be so profitable for the banks, and therefore would just simply not get done. So that brings us to the end of the presentation. This is just a little cartoon that we've been putting together at Finance Watch, and the idea is to try and sort of illustrate that the larger elephant there is a too big to fail bank, and too big to fail banks are unbalancing our economy, and if we try to do something, they threaten that if they go down, the whole thing's going to crash. And we argue that it's time for too big to fail elephant banks to go on a diet, to slim down, and to get in balance with the rest of the economy.
All right. But now let's move to the question that you sent us.
So hi everybody. We've got a question here from Fabian, which is quite interesting because it relates exactly to the drawing you just showed, Duncan. And Fabian is asking, how does this relate to Too Big to Fail, since Lehman Brothers was a pure investment bank? And this is a question we hear often. How come you ask for a separation, whereas investment bank alone can put the whole financial system at risk?
I think there the answer really is it is the size of Lehman Brothers, and Lehman Brothers had connections throughout the financial system, and so therefore the first risk was this one of connections throughout the financial system. Although I think it was more about the fear of its connections through the financial system. In the end, the losses per bank from Lehman's default were were manageable by the financial system, but more I think it was the fear that governments would let banks go, and they'd sort of assumed that that the government, after it had stepped in the Bear Stearns case, would step in with Lehman's. And so all of a sudden what happened was the doubt crept into the minds of people about what would and wouldn't be saved. And as we saw in the first part, once doubt starts to go, you can the whole commercial banking system is to use a phrase a confidence trick. And once the confidence goes, we see that the whole thing begins to unravel. What we think that separation would achieve would be to remove this ambiguity about what will and wouldn't be rescued in the case of a failure of an investment bank. So I think it's twofold. One is that they were just simply too large, and their failure causes problems around the system, and the second is one of some ambiguity about what will and won't be rescued.
Okay, thank you very much, Duncan, for this explanation. Another one relates to state intervention. And it's an interesting comment, and probably you will jump on that one to explain some other parts of our position. The comment we recite from Volcker is that the society has not to support the commercial banks if capital is enough. And definitely it's something we've been developing. We're not talking about capital, we're also talking about creditors. So maybe you could explain a bit more in details. What do we understand by state support, and when is it supposed to come?
I mean, I think capital is a very important part of the process, and just crudely speaking, the more the better. It not only provides a buffer against losses, but it changes or it can change the incentives about what is and isn't profitable. And as I say, if we can use it in that way to make some of the trading instruments that have emerged in the last 20 years less profitable, I think we'll see a rebalancing of financial activities. But it can't do everything on its own, and I think that there'll always be a case for the government to guarantee commercial banking activities over and above the capital buffer. And there's a certain self-fulfilling nature there. We sort of touched on at the top, is that if it's clear that the government will support and can support, then that support will rarely be needed, because people will not withdraw their money from safe, boring commercial banks. And it's the same with deposit guarantee schemes. The very idea is that you have a credible enough deposit guarantee scheme that it's never actually called upon, because people have the confidence that it's there. So I think that's the key thing about the support for commercial banks, is it should never actually be called upon if it is a credible level of support.
Okay, thank you. I hope this also answers the question from those 9% people who did not understand why we would support commercial banking when we asked for the first poll. We have, I'm sorry, but we have received a lot of questions. So
it's a good sign.
It's a good sign, yes. But first, I must say that I'm sure we will not be able to answer all of them now during the session.
I mean, I could talk about a little, just going back to the last question about
yes.
Recovery and resolution, which is another topic which is being discussed in European Parliament and legislature now, and the idea is that as we said in the first part, a commercial bank can't actually go into insolvency when it goes bust, because insolvency typically in Europe, we don't have something like a Chapter 11 like they do in the US, where the business is allowed to continue. In Europe, and they're different. It's different around the continent, but generally payments will be suspended. The whole thing has to be put on hold until the administrator can sort out who's owed and who's not owed. So what the Bank Recovery and Resolution Directive that's going through now tries to do is introduce a special bank insolvency regime that that would allow banks, commercial banks, to go bust, and for the government to impose losses on equity holders, so on the capital, impose losses on people that have lent via debt securities, and to protect depositors at the same time. Separation is only one piece of a broader package of regulation, which includes the capital directives, which, by the way, need to go further than they have done already in the coming years, and the Bank Recovery and Resolution Directive, which is going through now.
Thank you. I will now shift to a question about, which I think is quite interesting in the continuity of what you just presented and what you just explained. There is a question asking, downsizing banks is interesting, but what about decreasing interconnectedness? And I think you could comment a bit more on the benefits of separation, which is not only downsizing but also reducing interconnectedness. Maybe it needs to be explained a bit more in details.
Yeah. I mean, the first thing to say is that there will always be some degree of interconnectedness between the banking system. It's in its very nature that banks lend and borrow from each other. On any given day, one might have a surplus of cash, another one a deficit, and because bank credit money is acceptable throughout the system, there will always be some degree of interbank lending. That said, the growth of finance-to-finance type activities has greatly increased the degrees of connectedness. So to go back to Lehman's, there was an enormous interconnection through the financial system through their derivatives exposures, for example. So the growth of finance-to-finance products over the last 25 years has increased interconnectivity. And certainly, so it's not only downsizing, it's downsizing of certain activities which have increased interconnectivity. I don't know if you want to say something else about it.
No, I think this is quite clear, and maybe there is also the issue of the implicit subsidy that we've been highlighting several times in our papers of positions at Finance Watch, saying that this implicit subsidy that in fact banks, universal banks, benefit from because of the deposit base, make it possible to finance the development of those activities that we don't really need and that increase interconnectedness. They make it possible to develop it at a lower cost, and the fact that we separate will remove or shall remove this implicit subsidy and then come to both downsizing and decreasing the interconnectedness between the banks. There are several questions also on the alternative business models for banks. Because here we talked about and you commented on large universal banking model, but there are questions on, first, how do you draw the line between the small and the large? How at what point does the too large start? What do we at Finance Watch think of other business models such as local cooperative banks? These are probably issues that can be tackled in the same unique answer about the diversity of business models and where does the point starts when a bank starts to be a problem for society because of its size and its activities.
Sure. I mean, Finance Watch welcome a much more diverse banking sector, with cooperative banks, with local savings banks, with building societies, with more democratically controlled banks, with a larger variety. Currently, the largest banks absolutely dominate. They have extremely similar business models, and so in fact there's a very great lack of diversity in banking, the banking sector at the moment, exactly because they're dominated by 15 to 20 banks with the same business model. I mean, it's ironic that sometimes we hear from those banks that they bring diversity because they have all sorts of different activities under one roof. In fact, we would argue exactly the opposite. They are killing diversity. And as we say, we think that killing too big to fail, addressing the funding subsidy will actually make life better for different types of business models, for smaller banks, for cooperative banks, for saving banks. What exactly is the right number? I'm not sure. Andy Haldane has done, at the Bank of England, did some research that said above 100 billion, there starts to be diseconomies of scale. So that would argue that even for the shareholders of banks, you would think that they should start asking questions about the largest banks, which, I mean, the largest banks, to my mind, look much too complex to manage. I don't know how you would keep hold of managing an organization of thousands of legal entities with dozens and dozens of different business lines. And we saw 25 years ago the great conglomerates, and I remember Hanson from the UK, it was shareholder pressure that broke them up into more manageable size. So you have this 100 billion number that Andy Haldane came out with, where there's diseconomies that even the shareholders should be arguing. I think the Lickinen report has a similar argument around 200 billion. What I think our position, Finance Watch's position at the moment is that for now we don't actually need to make one single number, because I think it's complex. It's to do with the overall regulatory environment. It's to do with the degree of connectedness, as we've already heard from one of the questions, and so on and so forth. It's absolutely clear which are the biggest 15-20 banks, and they are qualitatively different from the rest of the banking market. I think that these are the ones that we should be turning our attention to first. And the second thing is that, as we said, there's also a difference in the business models. The Lickinen report again shows that the small and medium-sized banks have this much smaller percentage of trading assets, where the largest banks have as I say, a qualitatively different amount of trading assets. And this might be a way to start to address the largest banks, is not by looking at an absolute size, but saying what percentage of a balance sheet is to do with trading assets. And that, of course, brings us back to separation, where the very easiest way to start to tackle too big to fail is to split some of these banks into two and have two smaller banks instead of one larger bank.
Thank you. I don't know how much time we have left for
about 5 minutes, I would say, so that we close.
We can have then the two last questions.
But then those that we cannot answer today, we'll try to answer that writtenly and then put them on the website.
Yeah,
I think that's a suggestion that was sent by Andreas, one of the attendees. I think it's an excellent idea.
And there's, I mean, we have a Facebook site and a Twitter account, and feel free to get in touch with us in these newfangled social media ways.
And Duncan is working 24 hours a day, so even at night you have a question on banks, you contact him on Twitter.
We'll finish with two questions, which are a bit the billion-dollar question. Because I'm saying that because we hear them a lot. The first one, and I will let you then choose which one you want to answer first. The first one is how it's about the shift in culture, and I hope I will not change the exact it's a question related to the necessary shift in management culture. It's an issue that we hear that is highly commented. So how can we do that? Is it enough? Is it necessary, etc., etc.? So the culture. And there is also a question about the what we call the level playing field, which is, if we do that at a national level or even at a regional level, wouldn't it harm our banking sector? Wouldn't it be detrimental to our European economy or national economies, because investors would fly away if we split our banks? So these are really two questions that we hear very often, and I will let Duncan answer to this.
Sure. I mean, I think we all agree that we need a change in culture. But for me, culture is not something that just pops out of nowhere. Culture comes from the very nature of the activities. It's the practices that are driven by profit motives that lead to the culture. So the question of changing culture becomes one of changing the activities first. And for me, it's not the other way around. And so, as we've seen, commercial banking is typically about making loans which should pay back over a longer term, and it should have a longer term relationship based. It's a longer term, more relationship based activity, and I think tends to engender that sort of culture. It should be separated from the culture engendered by financial markets trading, which is much more focused on short-term price changes. So that would be a first step. That said, I think that the culture in financial markets also needs changing. Banks, as market makers, make their profits by buying and selling as much as possible, as often as possible. And so it's their very incentive is to publish more frequent price updates so that the owners of securities and other traders feel the need to trade more often and in greater size. And so this is like a race to the bottom that ends in the high frequency trading that we see now, where trades take milliseconds, and the biggest investment you can make is in your fiber optics or whatever the latest technology is to move yourself closer to the exchange. So I think, first of all, we need to separate the commercial banking culture from the securities market culture, and then secondly, we need to address this sort of race to the bottom in terms of speed and size of always needing to do more trading, which is driven by banks' profit motives, and which can be addressed with measures to encourage longer-term investing, which can other measures that put sand in the works, basically, such as the financial transactions tax. Now, I'll be very quick then. I think I've waffled on too long on that one, but on the level playing field, the thing is, our banks are still in a mess. There's still about $1 trillion of ECB liquidity support going to our banks. What our banks need in order to be globally competitive, and which would give them advantage over the rest of the world, would be for confidence to return in the banking sector, and it absolutely isn't there now. So the argument that if we put this stuff in, money's going to fly away sort of assumes that everything's all right now, but it's far from all right now. Some good, strong regulation now would actually be very beneficial to European banks. Confidence would return, they would attract funds. I know that the US is getting increasingly vocal on too big to fail. The Dallas Fed have been putting out stuff for about a month now, and I think it was raised in the Senate this week. Matt Taibbi in Rolling Stone as a piece on the increasing noise being made by the US on too big to fail. So we wouldn't be doing it alone. European harmonisation is very helpful here, although banking union might be a way off. If we could have minimum harmonisation on this sort of thing so that everybody had to do it at the same time, that would remove the disadvantage individual nations face to do it on their own, and therefore have a sense that they're competitively disadvantaged. And finally, I don't think banking will fly away from the euro. You know, there's 500 million people, there's an enormous economy, there's plenty of banking to be done, and there's plenty of banking activity left for people here. Where are you going to? We can't survive without banks. Banks can't leave us. You know, I wouldn't be too worried about them flying away.